All right, welcome to Talk Tickers. Today we're diving into a really interesting quarter from Civista Bank shares. You look at the headline numbers and things seem, well, a little mixed. But the way the market reacted and the moves management made, that tells a completely different story. So let's figure out what investors were really looking at.
Okay, so right out of the gate, here's the puzzle. On the one hand, you've got revenue coming in with a clear miss, about 3.5% below what everyone was expecting. But then you look over at net income, and it's a massive beat. I mean, up an incredible 56% year over year to $11 million. So what gives? How does that even happen?
Well, the market didn't seem too confused, did it? The stock actually jumped almost 2% in pre-market trading right after the news dropped. Now, that's not what you'd expect for a revenue miss. That's a reward. And it just goes to show you investors were completely ignoring that top-line number and looking at something way, way more important. So that's the big question we're going to tackle today. Why the disconnect? What was hiding in that press release? What did management say on the call that got investors so fired up? Well, the answer isn't in the numbers for the last 3 months. It's in a series of really bold, strategic moves they just made. Yeah, this was way more than just another earnings report. This was basically Civista unveiling a whole new chapter. Honestly, the numbers from Q2, they almost didn't matter compared to this flurry of announcements that just completely rewrote the story for the bank's future.
And I mean, just look at this timeline. You can see how absolutely jam-packed this period was. On a single morning, July 24th, they announced a major acquisition, a big capital raise, and dropped their earnings report, all at once. And this was just a couple of weeks after they launched a brand new digital platform. This is not business as usual, folks. This is a complete strategic overhaul, and they did it at lightning speed.
And here's the thing. None of this was random. These weren't separate moves. They were 3 parts of one single cohesive playbook. Management basically showed their hand and said, here's how we're going to re-engineer our future. So what's in this playbook? Well, it really boils down to 3 big things. Step 1, buy Farmer Savings Bank. Why? To get your hands on over $200 million in cheap, stable deposits. Step 2, raise a bunch of new cash to beef up the balance sheet and get ready to lend more. And step 3, launch this new digital platform, Mantle, to pull in deposits from all over, not just where they have branches. It's simple. Acquire, fortify, and innovate.
And you could just hear the confidence from management. I mean, the CEO, Dennis Schaefer, he didn't sound like a guy who just missed on revenue. No way. He sounded like a guy who just checkmated the competition. He literally said he could not be more bullish for the bank and its shareholders. That tells you everything you need to know.
Okay, so what does all this actually do for the bank? Well, look at this. This is the immediate impact. The combination of that buyout and the new cash is going to rocket their tangible common equity ratio, which is basically just a key measure of how financially strong a bank is, from 6.7% all the way up to a much healthier 8.6%. In today's tough environment for banks, believe me, a fortress balance sheet like this, that is exactly what investors want to see. And that third piece of the puzzle is Mantle. You can think of this as Civista's weapon for the digital age. It's a new online-only bank designed to just, vacuum up low-cost deposits from all over the country, not just from places where they have a physical branch. This is their big play to lower their funding costs so they can fuel all that loan growth they're planning. Okay, so once you understand that whole strategic plan, the rest of the earnings call, the guidance and the Q&A with analysts starts to make a whole lot more sense. Everyone basically wanted to know one thing. How is all this new stuff going to actually play out? And naturally, the first big question on everyone's mind was about profit. Specifically, what's going to happen to their net interest margin, or NIM? You've got an acquisition, you've got a capital raise, all these moving parts. So how's that going to affect their core money-making engine? And management was super clear on this. They said, look, expect a small temporary dip in Q3, down to about 3.53%. Why? Because they're using that new cash to pay down some expensive debt. But then, and this is the key part, they see it expanding again in Q4 once those cheap deposits from the farmers deal are fully baked in. It's a classic case of a little short-term pain for some serious long-term gain. All right, the other big topic was the market itself. Analysts were basically asking, okay, it's a knife fight out there for loans, and even you guys admit it's very competitive. So how are you possibly going to grow in this environment? And their answer was pretty straightforward. They said, you're right, it's tough, but that new capital, that's their firepower. It lets them be, in their words, a little bit more aggressive. They can go after deals now that maybe they couldn't have before. And that's exactly why they feel confident enough to project their loan growth will actually accelerate from the mid-single digits this year to high single digits next year. All right, so we've heard the results, we've broken down the strategy. Now it's time for our final segment, the next call. This is where we give you our prediction for what to expect from Civista next quarter.
Okay, so for Q3, we're actually predicting a small dip in earnings per share. It's just simple math, really. More shares outstanding means temporary dilution. But, and this is a big but, we think the stock price is going to keep climbing modestly. The market has already shown us it's smart enough to look right past the short-term stuff. It's focused on that profit margin expansion in Q4 and the faster growth coming in 2026. Because of that, we're slapping an outperform rating on it.
So if you were to think about a trade idea here, what would it be? Well, one that comes to mind is a classic pair trade. You'd go long on Civista to bet on their specific, well-thought-out plan paying off, but at the same time you'd short a regional bank ETF, something like KRE, to hedge against all the general problems facing the sector. What that does is it lets you bet on Civista's unique story while tuning out all the background noise.
And of course, we have to say it, this is all just a way to analyze a company's strategy. It's not a recommendation to buy or sell anything. This is not financial advice.